Welcome to RBC's Markets in Motion podcast, recorded January 13th, 2026. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, our thoughts on earnings heading into 4Q25 reporting season. Questions we think need answering and stats we're watching. Second, other updates include our thoughts on implications on changes in House views for the Fed for our own U.S. equity market outlook. Why we think last week's economic data releases support the strong start to the year in U.S. equities, why we think small cap performance is at an important crossroads versus large caps, and how recent trends in funds flows capture complex crosscurrents in place for U.S. equities today. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one. Earnings season offers U.S. equity investors a chance to put the macro on the back burner and refocus on the micro. 4Q25 reporting season kicks off this week with the big banks. Here's a rundown on what we're watching and hoping to learn. On the qualitative side, in terms of commentary, each reporting season our team reads through S&P 500 earnings call transcripts in an effort to glean macro takeaways, particularly breadcrumbs that a few companies may drop, which haven't yet become part of the broader conversation. As always, we'll be keeping an eye on general outlooks and what companies say on the health of the consumer and C-suite sentiment. Getting more specific, topics we'd like to hear from companies on include trends and plans for CapEx, both their own and their customers, both AI and non-AI related. For non-tech companies, their AI use cases and anticipated impacts for productivity, earnings, revenues, and/or margins, using specific numbers for their own companies, not just referring to general trends in corporate America at large. Additionally, how tariff-impacted companies are thinking about the implications for their cost, revenue, and margin profiles if SCOTUS doesn't uphold the IEEPA tariffs, and labor market dynamics, including whether AI technologies are impacting hiring and firing at their own companies. Perhaps this list is just wishful thinking, but it points to some of the important dynamics that we think will bear on U.S. corporate profitability in the year ahead, and in some cases, frankly, also points to areas where company commentary has simply been conspicuously lacking in recent quarters. On the quantitative side, in terms of the stats, at the broader index level, we'll be keeping an eye on the rate of upward EPS estimate revisions, our favorite gauge of earnings sentiment for the S&P 500, the biggest names in the index, and the rest of the index, along with the Russell 2000 and sectors in both index families. One of the things we think contributed to choppy stock market performance in late October and early November was the peak in the rate of upward revisions seen in the S&P 500 in August, including both the top market cap names and the remainder of the index. A new high in the rate of upward revisions in any of these slices could add to stock market optimism and refocus U.S. equity investors on the micro at the time when the macro issues have dominated the headlines, even though they haven't dominated the price action. We also think trends in this stat could play a role in the leadership rotation that's been underway in the U.S. equity market. A new high in the rate of upward revisions or stronger trends in either the biggest names or the rest of the index could reflect greater earnings excitement in one part of the stock market or the other and push investors back to either old leadership or reinforce the broadening trade that's been in place. At the S&P 500 sector level, those with the strongest revisions profiles of late have included tech, utilities, healthcare, and financials, when measured as the rate of upward EPS and revenue revisions, suggesting to us that the bar may simply be higher in these sectors than others. It's also worth noting that the rate of upward EPS estimate revisions has been weak, but improving for consumer staples, a potential sign of better fundamentals in a very inexpensive sector. By contrast, the improvement that was seen in energy revisions in late 2025 has proved fleeting as its trend has turned negative again. Moving on to takeaway 2. What else jumps out in the latest updates? To begin with, RBC's new Fed call is not a game changer. Our colleagues in RBC Rate Strategy changed their Fed call on Friday and are no longer looking for a cut at the January meeting or in 2026 at all. If they're correct, this would have a minimal impact on our outlook for the S&P 500 since the index's returns tend to be strongest during the 12-month periods when the Fed does nothing, a tiny bit stronger than the index's typical performance when the Fed cuts a few times in a 12-month period, the assumption that's been embedded in consensus expectations still and is currently baked into our 7750 12-month forward S&P 500 price target. Next up, last week brought some supporting fundamental evidence for the stock market's strong start. On the economic front, last week's soft data releases generally supported the risk-on tone to U.S. equity market performance as 2026 got underway. We continue to see signs of stabilization in the University of Michigan Consumer Sentiment Index, driven by stabilization in both current conditions and expectations. Meanwhile, the Challenger layoff data also highlighted an easing of layoff announcements both overall and in key industries like tech, as well as a number of cyclical areas where spikes had previously been seen. Moving on, we do think we're at an important crossroads for small caps. As we were reviewing the various performance charts that we monitor over the weekend, one thing that was particularly striking to us was that as of Friday's close, the Russell 2000 was back to its mid-October high relative to the S&P 500, when the first attempt at a small cap breakout versus large cap stalled, and a tiny bit above the level where the second small cap breakout attempt versus large cap fizzled out in December. In our view, the coming weeks represent an important test in terms of whether a new leadership cycle in small cap has begun. Looking beyond performance, it's worth noting that after having moved back down to levels nearly in line with the average late last year, the market cap weighted next 12 months forward PE of the Russell 2000 has moved up to 18.5 times. There is some room for this flavor of the Russell PE to move back up before it returns to its most recent high of 19.1, achieved in November 2024, but not a lot of room. While we generally thought last week's batch of economic data pointed to a strong foundation that justifies the strong start to the year in the U.S. equity market, we confess that the monthly NFP print did not look strong enough to us to signal that a durable shift in small cap leadership is underway. Nor did the sluggish reading in the headline index from the ISM manufacturing report. Historically, durable small cap outperformance cycles have been accompanied by a move up in the ISM manufacturing index and an acceleration in monthly jobs growth in the NFP data. We've also seen outflows from small cap funds in recent updates, including outflows from passive funds. And wrapping up with flows, which are a good lens into some tailwinds and headwinds for U.S. equity market performance. There were 4 big takeaways for us in last week's update from EPFR. First, passive retail flows to U.S. equity funds have been solid in recent weeks, suggesting to us that retail investors have been helping to support the rally in U.S. equities to start the year. Second, when we zoom out, we see that flows to U.S. equity funds as a whole have been choppy in recent weeks, though flows to global equity funds have been strong. We see the former as a headwind to U.S. equity market performance and the latter as a tailwind, given the heavy market cap representation of the U.S. and global benchmarks. Third, funds flows are showing a slight improvement for Western European equity funds, pointing to the possibility that some geographic rotation was already occurring within the global equity community as 2025 wound down and 2026 began. We will be keeping a close eye on this data, along with investor conversations to gauge whether a new Sell America trade may be returning to the U.S. equity market. This is an issue that we have seen as a key risk or headwind to monitor, and one that could reasonably be viewed as having grown or strengthened in the aftermath of recent geopolitical and central bank developments, though it's worth noting that RBC's rate strategy team has argued that recent events related to the Fed can be viewed as actually having strengthened perceptions of Fed independence. And fourth, at the sector level, we note improving flows for financials and industrials, 2 of the cyclical workhorses of the U.S. equity market, along with continued strength in energy and material commodity funds. Overall, we think all of these trends in the fund flow data highlight the complex dynamics underpinning U.S. equities today. Renewed and growing optimism on the U.S. economy, but within the context of a global investor community that has become more open to geographically diversifying their equity exposure and has been presented with some new reasons to potentially do so as the new year has gotten underway. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.